All right, let's talk about something we all have, we all pay for, and we all hope we never have to use. Yep, insurance. It's supposed to be our financial safety net, right? But how does it actually work? What are we really buying with those monthly payments? We're going to break it all down. Okay, let me ask you something. Just take a second. What's your biggest financial what if? You know, that nagging thought in the back of your mind? The one thing that could happen that would just throw everything off track. It's kind of a scary question, I know, but it's a feeling we all have. Maybe for you, it's a really bad car crash. Or what if a fire tears through your house? Or maybe it's the idea of getting sued after some freak accident. It could be any huge, out-of-the-blue expense that could just wreck your finances. Well, these aren't just bad dreams. They're exactly the kinds of problems insurance was created to solve. So, how in the world do you protect yourself from something so big and so random? Well, it all comes down to one really powerful idea, and that idea is pooling risk. Okay, so here's the magic trick. Insurance is basically just a deal. We all chip in a little bit of money, that's our premium, we give it to an insurance company, and in exchange, that company says, hey, if one of you has a really bad, expensive day, don't worry. We'll use the giant pile of money everyone chipped in to cover it. It's like a huge financial team-up. The power of the group protects each person in it. So really, it's just these 3 steps. 1, you pay your premium. 2, the company puts your money into this massive pot with everybody else's. And 3, if disaster strikes for someone in the group, the money comes out of that pot to pay for their big loss. Simple, right? But it's an absolutely brilliant way to handle life's what-ifs. Okay, so that's the big picture. Now, let's bring this down to earth and look at how it works in practice. We'll start with something most of us deal with, insurance for your drive. Now, here's something you might not know. Your car insurance policy, it isn't just one thing. It's actually a bundle of, believe it or not, 6 different types of coverage, all rolled into one. Each one has a very specific job to do. So let's break down the main parts. Think of it like this. Your policy has to do 2 big jobs. The first job is about protecting other people from you. That's your liability coverage. If you cause an accident, this pays for their car repairs and their medical bills. It's so important that most states legally require you to have it. Then, the second job is about protecting your own car. This is where you get things like collision, which pays to fix your car after a crash, and comprehensive, which covers pretty much everything else. You know, theft, hail, a fire, you name it. But what about you and your passengers? Well, that's where these other coverages come in. You've got medical payments, or PIP, that stands for Personal Injury Protection, and it helps cover your medical bills. And then there's uninsured motorist coverage. And let me tell you, this one is so important. It protects you if the person who hits you doesn't have insurance or doesn't have enough insurance to pay for your damages. It's a real lifesaver. All right, we've covered the car. Now let's take that same idea of bundled protection and apply it to what's probably your biggest investment, your home. Just like with auto insurance, a typical homeowner's policy isn't one thing. It's built on 4 key pillars. Each one is there to protect you from a different kind of financial nightmare. So what are these 4 pillars? Well, first, you've got coverage for the building itself, the structure of your house. Then there's coverage for all your stuff, your furniture, your clothes, your electronics. That's your personal belongings. Third, just like with your car, you need liability protection. This is for if someone, say, slips on your walkway and decides to sue you. And finally, there's this really cool one called additional living expenses. If, say, a fire makes your home unlivable, this coverage pays for you to live somewhere else like a hotel or a rental while your house is being fixed. Super important. And, you know, don't sleep on that liability part. It is so much more important than people realize. We're not just talking about a little accident. A serious lawsuit can be financially devastating. That's why, as you can see here, experts say you should have at least $300,000 worth of liability protection. It sounds like a lot, but it's there for a very good reason. Okay, now this is a really, really big one. A heads up that a lot of people unfortunately learn the hard way. Your standard homeowner's policy does not cover everything. And the 2 biggest things it almost never covers
are floods and earthquakes. If you live in an area where those are a risk, you absolutely have to buy a separate policy for them. It is not included.
All right, for our last section, let's talk about something you absolutely need to know. This is a critical choice you make when you buy your policy, and it all boils down to one simple question. If your stuff gets destroyed, do you want the insurance company to pay you what it was worth or what it costs to go out and buy a brand new one? This choice defines how you get paid after a claim. On the one hand, you have actual cash value, or ACV. This pays you what your stuff was worth at the exact moment it was destroyed. So think about your 5-year-old TV. ACV gives you the money for a 5-year-old TV. But on the other hand, you have replacement cost. This pays you the full amount you need to go to the store and buy a brand new TV. As you can imagine, the difference in the check you get can be absolutely massive. Now, it's true, a policy with replacement cost is going to be a bit more expensive. Your premium will be higher. But if the worst happens, that extra money you paid is what makes it possible to actually get back on your feet. It's the difference between being able to replace what you lost and having to pull thousands of dollars out of your own savings to make up the difference. So when you boil it all down, insurance isn't just another bill you pay every month. It's a promise. It's a promise for a price. A company is making a promise to you that if disaster strikes, they'll be there to help you rebuild. Which leaves us with one final, very important question. Are you sure you know what your policy promises you? I really hope this explainer helps you figure that out. Thanks for joining me.